What's up everyone, Rose Brown, the accountant therapist here, and welcome to week 2 of my Tax Tip Tuesday live videos. This week I'll be talking basically about the taxability of your income, whether or not it's taxable, how it's taxed, what's going on there. Because depending on the type of work you do, the type of income you earn, you will be taxed a certain way. So stay tuned and let's dive right into it. With that being said, I am the CEO of Brown's Fulfillment Consulting and Accounting Firm. We are located in Center City, Philadelphia, and we do provide services to clients across the United States. So don't worry, we have a service that can fit your need. And of course, a part of what we do is tax preparation, tax advisory. If you ever have any question, especially after videos like these or the ones from last week, right? You want to go ahead and email us at info@browns.fca.com, or you can reach out to us on social media platform, Facebook, LinkedIn, Instagram, Twitter, at Browns_FCA. And of course, you can browse our website to see, well, how really our services will be able to fit your needs. With that being said, for me, you can indeed follow me on social media platforms at The Accountant Therapist, Facebook, LinkedIn, Twitter, and Instagram. Okay, so here's the thing. Last week, first let me talk about last week for a quick second, and then we'll dive deeper into what's happening this week. So last week I talked about a very popular conversation, and that's about the stimulus payments. You know, the ones that we received, the $1,200, the $600, or the PPP, which is the Paycheck Protection Program, or the IDA loan, Economic Injury Disaster Loan for businesses, right? So either way, the government made available funds for individuals and businesses. Now, as it pertains to those stimulus that we received, if you are having issues with it where you haven't received it or the system is saying that you're not eligible, there's a couple of things that I want you to do. And again, I deeply discussed this last week, and if you need to go back, you can go ahead and review that live video from last week. But nevertheless, if you are having issues with your stimulus payment, visit irs.gov and click on Get My Payment. Once you click on that tab, you'll be able to put in your information so that they verify you. Once that's done, they'll basically tell you if you've received it, when you received it, how you received it, if you haven't received it yet, when you'll receive it, and how you will receive it. So this pretty much gives you a lot of data. So if you go through that now, and it's telling you that, hey, you're not eligible, when indeed we can prove that by looking at your tax return. When we go to do your taxes this year, we'll be able to claim what is called a rebate recovery credit. And that way you can receive that stimulus as a tax credit. And what that will do is it will in turn increase your tax refund or decrease your tax liability. So either way, they're trying to ensure that you receive these funds, even if it's a little bit delayed. So with that being said, let's dive right into this week's topic. So a lot of us, we earn income, right? But a lot of us obtain income some other way. So let's talk about that. But before we talk about that, income can be earned through us getting money, right, from an employer, or property or services, which I'm going to be talking about later in this video. So stay tuned. And again, if you have questions, just follow along, comment, let me know what's going on, because these can be foreign to a lot of people. So we have 3 types of income. You have earned income, you have passive income, and then you have portfolio income, which is also referred to as paper assets. So let's talk about that a little bit deeper. The first one, earned income, right? So earned income is typically you providing your personal services in return to be compensated. Now, typically, this is what a lot of us are acquainted with, because at one point or another, we may have had a job where we earned wages, salaries, tips, commissions, you name it. Anything that you've provided your personal service for and you receive compensation, that's earned income. And that is typically taxable, right? So even if you're self-employed, an independent contractor, and you go out to do some type of work, that income that you've made is earned income. Now, the way this is displayed on, say, a tax form is one that we're familiar with, a W-2, right? So whenever you work your wages at year end, you receive that W-2. Now, on that W-2, it will display pretty much everything that will be taxable. including fringe benefits if you did receive that. And then the flip side of that is if you are a self-employed individual, independent contractor, you would have received a 1099 from the person who hired you to do the work at hand. So the thing to note about this is, as a person earning income, you would have received, you're in the ordinary income tax bracket. And in the ordinary income tax bracket, you fall between a 10% and a 30% range that you can fall in. But in addition to that, you're also paying employee taxes, referring to Social Security and Medicare taxes, right? So if you're an employee and you look at your pay stub, you'll see Social Security and Medicare taxes withheld. Whereas if you're a self-employed individual filing taxes on a Schedule C, at year end, whatever profit you've made, you have to pay Social Security and Medicare taxes on that as well. And that's typically, if it's you and you're just self-employed, that's 15.3%. Don't worry, I have a live coming up just to talk about all my self-employed individuals. So again, if you're earning income, you're paying both ordinary income taxes as well as those Social Security and Medicare taxes. And hey, that can add up pretty quickly. And because of that, earned income earners are typically obligated to pay the highest taxes, and that's because you have a lot of moving parts both on the federal and state aspect of things. So let's take a pin right there. A lot of conversations around the money or the funds that were received last year, and I know a lot of people have questions about that. So hi Julia, how are you? So as it pertains to, for example, the stimulus and the unemployment, a lot of people are referring to these as free money. Yes, some are free money, but let's kind of put it in black and white instead of having gray areas. So that stimulus payment that we received, that $1,200 or $600, that is not taxable. You do not have to report it on your income tax return as of this date, right? So the government gave those funds in order for individuals to meet their basic need because of the disaster this pandemic caused. And those funds are cannot be counted toward wages. That means Social Security or government assistance cannot ask to use this as a viable option to qualify you or deny you for any assistance of that sort. So that's that. The stimulus, not taxable. Don't worry. The next part is the unemployment compensation. Now, the unemployment compensation, both the regular one and the enhanced $600, now $300 a week, right? Those are absolutely taxable. So you want to make sure that if you did not put on there when you're filling out those documents that, hey, I want you to take out at least 10% from the compensation that you'll be giving me. You have to be aware of that. Come this tax season, you may be seeing a sizable tax liability, something that you may not have seen in the past. Because if you receive those unemployment compensation without taxes withheld from it, at that point, you're receiving upfront money, and then you're then left with the consequences when you file your taxes. So kind of keep that in mind. And if you were one who did not do that 10%, just go ahead, log back in, and make sure that you begin to have them take out those funds moving forward. So now that that's done, earned income, remember, you're typically tax heavy in that category. The next one is the passive income. Now, passive income is often associated with, individuals who are involved with real estate activities, right? So if you actively or passively manage real estate, you fall into this category. And oftentimes, say you're a business owner, for example, and you have started a business and say 10 years go by, the business did very well. There's no need for you to be there. You're not doing any day-to-day work. At that point, you become passive. So you're a passive owner there, so you receive passive income. Now, the way you're taxed as a passive income earner is the ordinary income tax rate. So at this point, you're not worried about Social Security or Medicare taxes, but you're just worried about your ordinary income tax rate. Again, that could be from 10% to 37%. So it can get pretty high. But with that being said, you would often report that, of course, on Schedule E if you're a passive income, oftentimes, depending on your particular situation. So as we move on to talk about that last part or segment of the income, is your portfolio. So again, we talked about earned income, we talked about passive income, now we're talking about those portfolio income. And portfolio income can refer to as your paper assets. And of course, those are your bonds and your stocks, and of course your dividends and your interest. Now, whenever you receive funds from, say, your bank for saving with them, or you sold stocks, that's when you kind of trigger a taxable event. Now, a taxable event can be looked at in two different ways depending on what you triggered, really. So let's use stocks, for example. If you sold stocks, for example, in 2020, you would receive this year Form 1099-B, listing all the stocks that you sold. And of course, you have to report that and you'll be taxed accordingly. Whereas if it's interest, you would receive Form 1099-INT, or if it's dividends, it's Form 1099-DIV. I'm saying these forms to kind of get you to start thinking if you are one of these individuals, so that when you're filing your taxes, you don't miss these documents. It's incredibly important that you keep track of these things, because if you miss reporting income, the IRS will come back and say, hey, you did not claim this income. Now I have to, or now I will be charging you interest and penalty. So we want to make sure that we capture everything that you were actually involved in 2020, right? So now when we look at, you've now received the form. What happens after that is we look at what income tax will that be assessed. Now, when we look at income taxes for portfolio income, it can be taxed in two different ways. It can be taxed as ordinary income tax, which again is your 10% to 37% tax bracket, and that's usually for the general public. And then the other one is the capital gains tax rate. Let's break down what's happening there. So what triggers an ordinary income tax rate versus a capital tax rate is your holding period. Your holding period refers to how long you've held that asset for. So let's say you purchased a stock today, you sold it tomorrow, or 6 months. That means you've held the asset for less than a year. When you hold an asset for less than a year, that means it's short term. And at that point, you're taxed using the ordinary income tax rate. And then on the flip side of that, let's say you purchased the stock today and you sold it a year and a day later, or 2 years, or whatever it may be. But as long as it's more than a year, you're then using the capital gains tax rate. Now, that is very favorable for a lot of people. And that's why people use this particular type of income to build wealth, because using the portfolio income, you only have 3 rates in the capital gains. So you can either be taxed at 0%, 15%, or 20%, compared to the ordinary where you can go all the way up to 37%. I mean, that's a huge difference. And that's why we have to be very strategic when it comes on to taxes. And I know we want to earn money in so many different ways, but we still have to know that it's exciting to earn money, but it's also frustrating to deal with the taxes. So you have to sit down with a tax professional like myself to go through the types of income you're earning. How will this impact you, right? So with that being said, let's talk about a couple of other taxable income. So of course we talked about your wages, your commissions, your tips, and that also includes employee fringe benefits. So for example, let's say your employer paid you or gave you a car. That has to be reported as a taxable income, right? And then of course you have your self-employed income. So if you went out, you did freelance work, if you're Uber driver, Lyft, things along that line. And then if you had gambling winnings, so of course, if you won the lotto, you have to report that. Even if you just went to the casino, you need to report those earnings. And then lastly, bartering. Now let's talk about that for a second. Bartering meaning we are exchanging services and money's not in the midst of that. It's just our services. Now, so for example, let's say I need my windows fixed. I call in a carpenter and I said, okay, I will complete or file your business tax return. In exchange, can you fix my window? Here's a breakdown of what's happening here. The services that I provide to him is a tax write-off. The services that he provides to me is a tax income. It's a revenue that I have to recognize, but I can't write off the work that he did for me because it's personal. But because what I did for him is business related, he can write it off. Either way, we both have to recognize those services that we both provide each other as revenue, right? So it cannot go unseen. Basically, anything that you do, whether it's earned, passive, or portfolio, the government want their share. Whatever it is that's taking place, they want to ensure that they receive their portion of what you've obtained. So the flip side to this is what's non-taxable, what's not taxable. So of course you have your government assistance, child support, and of course income from hobby. Now, if you have a hobby, right, that means you're just doing something for fun. You're not in it for the income, the business. You're not relying on this to provide assistance to live in. You just do it out of fun. For example, if you had art that you were doing, anything along that line. And then the last piece about this taxable income versus non-taxable income is Social Security compensation. It's important that we note this because a lot of people get tripped up because they've earned more than they can obtain in Social Security. So there's a part where, or there's a potential for Social Security benefits not to be taxable. However, if you begin to earn over a certain amount, then you start entering into that taxable phase where up to 50% or up to 85% of that Social Security benefit can be taxable. So you have to kind of be mindful about your combined income. That means anything that you've worked and other sources of income plus that Social Security. So again, you want to sit down with a tax professional like myself to kind of go through all that you have going on to ensure that you legally avoid these slip-ups. So that's pretty much it. So let's run down what we talked about today. We talked about the 3 different types of income. Of course, that's your earned income. Typically, we actually have to provide a personal service to obtain compensation. And then you have your passive income, and that's usually associated with your real estate activities. And then, of course, your portfolio income, which is your stocks and your bonds, your dividends, and your interest income. Now, these are all taxed at different tax rates, right? And it's based on how you obtain those funds and how long you've held those funds. So again, if you're earned income, that means you had a job, you have to pay ordinary income tax rate plus having to pay Social Security and Medicare taxes. Whereas a passive income earner, you only have to pay the ordinary income tax rate. And then as the portfolio income earner, you would either be taxed using the ordinary income tax rate or your capital gains tax rate, where you have the ability to be taxed at either 0%, 15%, or a 20% tax bracket compared to, say, a 37% for ordinary income tax. And again, that's why a lot of people pursue the route of obtaining a portfolio income.